I saw you on CNBC the other day, and you said something that I want to touch on because it was oddly comforting for me. You said, I have a feeling when we look back on this period in 10 years from now, the next few months are when we're going to say, man, I wish I would have bought a little bit more. Can you speak to this for our listeners who may be feeling a little bit dicey about investing in general right now?
Yeah. So I remember saying that. I think it was a few weeks ago now. So, it was before this most recent drop in the market. So I'll walk through just kind of the thought process there. There's a few different things that people need to keep in mind when you're investing. And first of all, it is completely natural to be trepidatious right now. I think there's a lot of things going on. There's a lot of headlines that come out. The market is clearly down on a year-to-date basis. It's very anxiety producing for everyone. And as much as people like me say things like try to keep the emotion out of investing, it's impossible. It really is impossible, especially in a year when there's a lot of things that are just making us nervous. And we're looking around the globe and you're hearing about things from other countries that are happening that are starting to really scare people. So totally natural to have those feelings and have some of that trepidation. What you have to try to do is remember these things. So markets and economies go down in a certain pattern, and it happens like this almost every time. What you usually see is that the market drops first, the economy breaks later. So the market is a forecasting mechanism. It's a forward-looking mechanism, and it tries to predict where the economy will be and where corporations will be, where their corporate health will be in 6 to 12 months from this moment right now. Okay? So a very simple way to say it is that the market bottoms first, the economy bottoms after that. If you want to get even more detailed about it, usually what happens is the market bottoms first, corporate earnings bottom second, the economy bottoms last. Okay? By the time the economy bottoms, the market is already recovering, usually. So, what I meant by that statement was that we are in a time right now. Obviously, the Federal Reserve is raising interest rates. That's put a lot of stress on the economy. That's put a lot of stress on the stock market. It's put stress on the bond market, which I hope we can talk about later. But we're in a time where people are increasingly nervous about the idea of a recession and that this recession is getting closer and closer. So what happens when people are nervous about something like that is that it gets priced into the stock market present day. Okay, so we feel the pressure in the stock market sooner than whether or not we find out that we're in a recession. So let's assume the recession starts in the first quarter of 2023, if we're going to have one. The stock market is going to go down right around nowish, and obviously has already gone down this year, but it's going to try to get ahead of that. So my statement about, I think we're going to look back on this period and wish that we would have bought more now, was because if we do have a recession, I feel like it probably comes early in 2023, or it begins early in 2023, which means that the market is going to feel the stress now. And when we look back on it over a long-term period, this will look like a time when things were attractively priced from a stock perspective.